We are here today to talk about trading unusual options activity. And just so I have an idea of where we stand here and how much knowledge everybody has on the topic, how many people in here have never, ever heard the term unusual options activity used before? How many have never heard of it, have no idea what it is I'm going to be talking about? Don't even trade options might be a better question. So there's a lot of people that says they've never heard of it before, and I'm not surprised that there's some people that haven't, but I'm also not surprised that a lot of you have heard of this topic before, because it is something that has been very prevalent in the news over the past year and a half or so. There's been a fair amount of insider trading cases surrounding unusual options activity. So we're going to talk about looking at unusual options activity as a possible window into insider trading, but that's not the whole story, and we're going to cover both sides of it here. So bear with me here while I read our standard boilerplate risk disclaimer. Day trading, short-term trading, options trading, and futures trading are extremely risky undertakings. They generally are not appropriate for someone with limited capital, little or no trading experience, and or a low tolerance for risk. Never execute a trade unless you can't afford to and are prepared to lose your entire investment. All trading operations involve serious risks. No trades or recommendations are advice, and we cannot be sued for losses of capital. Please contact your broker or registered investment advisor for all execution, margin, and other capital requirement questions. Everyone watching this presentation hears to all disclaimers on optionhacker.com and keenonthemarket.com. So Reed did a great job of giving me an intro there, so I'm not going to spend too much time talking about myself. But my name is James Ramelli. I actively trade equities and equity options in our live trading room here all day long, and I'm regularly on CNBC, Bloomberg, Fox Business, and BNN Canada to talk about options. If you watch financial news, I was on all of those networks last week except for Fox Business. So maybe you saw me on TV. If you haven't seen me on TV, I write a fair amount for Futures Magazine, Active Trader, Resource Investor, and CME Open Markets Magazine. But enough about me. Let's talk about unusual options activity. So the first thing that we want to do is define unusual options activity, talk about why we actually care about this order flow, and then finally show you some examples and then an actual actionable trading plan that you can use this information to turn into actual trade ideas. So the first thing that we want to talk about is what unusual options activity actually is. So stocks that have options listed have an average daily options volume, right? They all do, and it's all relative. The average daily options volume for Apple is much larger than the average daily options volume for Whole Foods. Right? It's just how it works. Everything is relative. So we can look at any type of order that comes across the tape and determine if that is a quote-unquote normal or unusual trade. And an unusual trade is an order that is taking place above the average daily volume in a given stock. Now, unusual options activity is tracked by looking at the actual orders that are being executed in the equity options market. And we look at every single equity options exchange in the country to see all of this order flow. But when I see big blocks of options being bought or sold, that represents institutional bets. And it lets me see what institutional players are betting their risk capital on. It lets me see where the smart money is going. Okay? So a lot of people say, well, how come this works with options? Why can't we apply this same idea to trading futures or to trading stock? But it doesn't really work in those markets because a lot of that order flow is hidden. And let's talk a little bit about that here. So let's think about the order process that takes place in the equity options market. An institution is going to create an order based on research, information, and analysis. Okay, so if I am sitting at a hedge fund desk on the options desk, we're going to come up with some type of trade, some trade that we want to put on in the market and risk some money on. Now, the information and the analysis that I'm going to use to come up with that idea is probably happening at a much higher level than anything any of us have access to. And we're going to talk a little bit about that more on the next slide here. But after I come up with my trade idea, I then call up my broker to try and get the trade executed. The broker then shops that order all over the place to trading desks and big market makers that they think could take the other side of my massive institutional-sized position. Okay, Citadel, Goldman Sachs, Barclays, JP Morgan, Bank of America, the prop shops here in Chicago. If none of those guys want it, they send the order to the pit. If none of those guys want it in the pit, then the broker has the choice of executing the order for themselves and telling their customer they got to fill and then dealing with the risk by hedging it out on their own. But what's really important is that it doesn't really matter to me at what point throughout this process the customer's order is filled. All that matters to me is that no matter what they do, I'm going to be able to see that order taking place. Okay? So at no point throughout this process do they have the ability to send this to a dark pool. And does anyone not know what a dark pool is? Has anyone never heard the term dark pool in terms of trading before? Well, a dark pool, very simply put, is a center of off-exchange liquidity that big institutional traders can transact with each other in without anyone else seeing their volume or order flow. So let's say that I have 1 million shares of Apple that I want to sell. Well, I can go to the dark pool and say, hey, I have 1 million shares of Apple that I want to sell. Does anyone want to buy it for this price? And then if someone does, we can transact with each other, and the volume and the price action related to our trade and all the other relevant information is hidden from us. It never shows up in the volume that we would see in my Thinkorswim platform or my Interactive Brokers platform or in my E-Trade platform. It's completely hidden. Okay? So there are no dark pools for options, which is what makes options the ideal instrument for tracking institutional money flow. Okay? Because no matter what they do, they have to send that order through some type of public exchange, be it the SIBO, the PHLX, NYSE, the BSX, it's hard to write with this pen, I apologize, the BSX, whatever they choose to do, it has to get executed no matter at which point in this process it is executed. It has to be done on a public exchange. So what does that mean? That means that all of the relevant information tied to that trade must be made public for all market participants. They don't have the option to hide their order flow like they do in the stock market, okay? So this is what makes equity options the ideal instrument for tracking institutional money flow. It works better than stock. It works better than looking at futures. It works a lot better than waiting for disclosures or for quote-unquote insider buying and selling from those who are involved in the company. So why do we actually care about that order flow? So now that we know that we can identify it, why does it matter? You know, it can mean a lot of different things when I see a giant block of calls being bought by an institution, but why do I think that they know more than I do? And well, one of the main things that they have as an advantage over me that I'm never going to be able to replicate is capital. Even a small hedge fund could have billions and billions of dollars in capital behind them, and it's not necessarily that capital that gives them the inherent edge, it's what they derive from that capital. It's the manpower, technology, and information advantages that they get by having so much money. And it all starts with information. Now, let's talk for a second about public information, information that we all have access to. Well, you know, some might logically think that if it's a level playing field and we all have access to the same amount of information, then the hedge fund shouldn't have that much of an advantage. The big mutual fund shouldn't have that much of an advantage, but that simply is not the case. The fact of the matter is that the technology and manpower that institutions have access to means that their level of analysis that they can do with all of the public information that's out there is so much higher than anything I can hope to replicate. How many of you in here spend time outside of regular trading hours doing quote-unquote homework? Reading articles, looking at financial statements, looking at charts, looking at technical setups and studies, coming to webinars like this to learn more about trading, reading about the companies that you're invested in or ones that you might want to invest in. And if you guys spend time outside of market hours, how much time do you think you spend? Do you spend 2 hours? Do you spend 4 hours? Do you spend 10? Do you spend 30? Some people say they spend as much as 40 hours a week doing research outside of market hours, right? And some of the people that are saying right here, yeah, we spend. Fortunately, even for those of you that are spending 30 hours, 40 hours outside of the regular trading day doing research and doing work, you're never, ever going to be able to do as much as a team of a half a dozen quants with PhDs in physics and math from Harvard can do for a hedge fund. Okay, so I know that I have a disadvantage in the fact that I'm never going to be able to do that much analysis like they do. But let's add one piece of information back into this. What about all of the insider information that they're not supposed to have? Does anybody in here think that insider trading on an institutional level doesn't happen that often? And when I say insider trading, I mean trading off of non-public information that is material to the price of a stock. Do you guys think that that doesn't happen that often? Does anybody think that it doesn't happen that often? Right? Most people would agree that institutional level insider trading happens fairly often. And they typically do it with options. And why is that? Right? It has people saying, yeah, it happens all the time. Why do they do it with options? Because options are a leveraged product that gives them the most exposure that they can get if they have some type of insider information. Options are also much less understood than other products, and regulators oftentimes have trouble catching these guys when they do it. Okay. Now, I'm not saying that it happens, that the vast majority of institutional traders out there are doing this. Most of them aren't. But it was shown in a study that was done about 2 years ago that around 25 to 30% of every single M&A deal that happens in a year has some type of unusual options activity telegraphing the move ahead of the deal announcement. Okay, so it happens all the time. It happens way more often than most of us probably think about. But if I don't have that insider information, and even with the public information I do have, I can't do this much analysis, does that mean that I'm always at a disadvantage? No, because I can get the end result of all of that, which is a trading idea, right? Everything that goes into this process, into the hedge fund machine, the one thing that comes out is trades, and that's exactly what we're looking for. The trades are what matters, and this is what they look like. Okay, this is what it looks like when you see a order hitting the tape on a publicly traded equity option that comes through a public exchange. They have to give me all of this information. And if you don't have a scanner, we actually got this little piece of snippet of information from a scanner called Trade Alert. If you don't have a scanner, there's a lot of options out there for you to find this order flow. TradeStation has a scanner for unusual options activity. Thinkorswim has a scanner for unusual options activity. And while it might not be formatted in this exact same way, all of the same information is there because it must be provided to you as a market participant. So how do we, now that we know we care about this order flow, how do I identify the actual orders that are considered quote-unquote unusual? So let's take a look at all of the information that I have here and see if I can make a determination on whether or not this is a quote-unquote unusually large trade. Well, first thing that I see here is that it happened about 20 minutes after the open of the day. I can also see that these were bought. There was 5,000 lot, which is a big trade, in ConAgra for July expiration at the 39 strike for $1.08 when the market was 90 cents at 105, and it's labeled an opening position with stock at 38.29. Now, the first thing that I noticed right away is this is a big trade. It's 5,000 lot at $1.08. How much risk is that? Well, that's $540,000 in risk that this trader is taking on with just this position. That's a big amount of risk, and that automatically tells me that this is an institutional trader that is making this trade. How many traders do you think are sitting at home as retail traders, swinging $500,000 worth of options back and forth on a daily basis? It doesn't really happen that often. So I automatically know that this is coming from an institutional trader. And I can also see that the market at the time of the trade was 90 cents at 105, meaning that this trader paid more than what the best offer in the world was, so he knew that he would get filled in his position. One analogy that we use for this that really flags and signals unusual options activity is, when demand for options is very high and they pay through the offer, well, that is something that shows quite a bit of aggressiveness. We're seeing this happening in real estate markets in New York and San Francisco all the time now. People come in with their first offers higher than what the current market offer is to ensure that they get a fill, to ensure that their position is filled, that someone will sell to them, right? These traders that do this in the equity options market, they do it because they know that they have to get these. They need to get into this position. And let's take a look at maybe why this trader cared so much about getting into this ConAgra trade. Well, this trade happened on the 16th of July, okay? So if we go back here, I'm sorry, the 16th of June, my bad. Let's take a look at the day that this happened. This is the date that the trade took place, right here, okay? So relatively nice looking chart in ConAgra, but what happened 3 days later? On the 19th, the announcement was made by JANA Partners that they were going to take a 7% stake in ConAgra, and the stock ripped to the upside. And the 39 strike calls that they bought for $1.08 traded as high as like $6. They got as high as it got stock as high as $44 right here. Now, based on this chart pattern and based on the aggressiveness of the trader's entry, and the following news release that caused the stock to catapult to the upside, would you guys guess that he got lucky in this trade or that he knew something? What do you guys think happened? Did he get lucky, or did he know that this deal was going to be announced? Did he have some type of read, or did he know for a fact that JANA Partners was going to make this announcement? Right? Pretty much everyone that is responding to the question is saying no, he knew, right? It's fairly obvious that he knew. So I can see catch orders like this, and I actually made a fair amount of money in this ConAgra trade. I didn't buy this particular line of options. I saw some other options that came across that I traded for a really nice profit. But this is the type of order flow that we're looking for, suspiciously large and aggressive order flow that might signal that someone knows that something fishy is going on, or someone knows that something is up, something is going to happen. So he's lucky he knew, right? Maybe that's a good way to put it. He's lucky that he is in the same foursome at the country club with someone, VP at JANA Partners, that told him, right? We don't really know how he got that information or why he had it, but we know that it worked out for him. So let's look at another example here. So this order hit the tape. Oh, I'm sorry. This hit the tape last week. Sorry, I meant to change that. But it was the day after Dean Foods reported earnings. Okay, and the stock was selling off, and the stock was short stock restricted. But this is a large trade. These are front month options that a trader came in and bought aggressively as the stock was starting to sell off on the open. And we can see the same types of things happening here. They paid the offer. They bought every single contract on the offer, because you can see there was only 339 there. It was an opening position, and it was an unusually large trade. This is a big trade for Dean Foods. There are not that many derivatives traders that put on big aggressive positions in Dean Foods. But take a look at what happened here. This order hit the tape shortly after the open while the stock was short stock restricted, and after it had started the staged comeback. If something is extremely heavily shorted and it's starting to rally higher, and I see a trader coming in and putting on a big aggressive bet with front month options, risky options, what can I assume he happens? Short squeeze, right? You can see that this trader is coming in and betting on what's happening here in food. So this is an example of someone who didn't have insider information. Big market, saw a certain dynamic developing in the market, and was able to go ahead and take advantage of it, equity, and was able to make a very nice profit in this position. So let's take a look here. The next morning, I should say the next morning, those call dollars bid at $2.15. So the trader that would have bought 20 of these calls would probably be hundreds at the high on $700 worth of risk, right? How much money did this instrument make? He would have sold those on the bid that morning. He would have profited. So it was a $165,000 profit for him overnight that he had on the market here in Dean Foods. So this is an example of a trade that wasn't necessary information. It just showed me where institutional money was looking for a pop higher based on momentum in the underlying after a catalyst event. So this is another example of the type of order flow you see. It's not, you do see a lot of that going on. This is probably the best example that we had all year, and our that were able to trade made a ton of money in this position. But a trader bought 5 June 70 cents on March 10th. I wish I had a pleasing snippet to show you here, but since Kraft no longer trades as Kraft, I can't actually pull the historical information. But watch what happened to the stock after this order hit the tape. The stock kind of languished for a while, maybe about 10 days or so, before the announcement was made that Kraft and Heinz were going to merge. They were going to be trading under a new ticker, KHC, and that they were going to be the biggest food conglomerate in the world, and Kraft was going to be paying an enormous, massive special dividend of like $16 to all their shareholders. And what happens, the stock explodes to the upside. These calls traded as high as $22.70 after that announcement happened. So what does that mean? That means for every one contract bought where I could have risked 40 cents, I would have made $2,200. An absolutely massive, massive profit, right? That is home run territory profits. And again, I'll ask you guys, and I think you will all probably answer the exact same way again. In this particular trade, do you guys think that this trader got lucky, or do you think that he knew that this deal was going to be happening in craft? And this is what you kind of have to understand when trading unusual options activity, is that an order like that in a stock like Apple wouldn't even draw a second look from me, because a 5,000 lot in Apple isn't really that large. But do you guys think that there's traders coming in and putting on big aggressive bets with calls in a stock like Kraft on a regular basis? Or does this one stick out a little bit more? Does this one stick out a little bit more? What do you guys think? This one sticks out a little bit more, right? There isn't that much aggressive activity happening in a stock like Kraft. They don't do this in a stock like Kraft. Kraft is boring. Kraft is a boring stock to trade. And you know what? So is ConAgra. So we look at the order flow, and it's all relative. People say all the time, and I'm sure I'll still get a question at the end of this that says, what is the minimum size contract order that you're going to want to look at and consider unusual option activity? I'm going to say it doesn't work that way. It all depends on the stock, right? And that's where looking at average daily volume comes into play. So we can see here that we have several examples of why this works out well, right? Hedge funds and big traders have more information than us. Whether or not that information is insider information that they're not supposed to have, non-public information material to the stock price, or whether or not it's, a good read on a momentum and pressure situation like in Dean Foods, it doesn't really matter. I still care about the order flow. It's like being able to see what Icon, Einhorn, Loeb, Ackman are doing before they disclose. These activist investor guys, they use the equity options market to wedge themselves into a stock position before they have to come in and disclose. We see this happen all the time. A couple days after we see a bunch of options activity in a stock, we see an announcement from an activist investor that says, hey, I'm taking a big stake in this, just like what we saw there in ConAgra. Okay, so people ask me all the time, if they're using insider information, if I trade off of that order flow, have I done something wrong? And the answer to that is absolutely not. As soon as someone who has insider information that they're not supposed to have and makes a trade on it, they have broken the law, and regulators will find them and they'll get in trouble if they're caught, right? But as soon as that order hits the tape, that becomes public information. And someone like me who simply looks to interpret the order flow and find the suspicious looking trades is doing nothing wrong, because I'm using nothing but public information to make my trading decisions. Okay? So does that make sense to everybody so far? We talk about this a lot as insider trading. Why does it happen? Why is this still something that we're able to follow? And my answer to that question always is, well, do you think that most traders that do it get caught? And the answer to that, in my opinion, is no. That the vast, vast majority of them that are using the equity options market to trade with insider information are not getting caught. And they know that even if they do get caught, what most likely is going to happen to them is they're going to have to pay a fine, right? They're going to have to pay a fine. They're going to get a slap on the wrist. It's not going to be the end of the world for anyone. No one's going to go sit in jail, right? And, that's if they get caught. The SEC has a massive, massive backlog of cases that, they have trouble getting through, and by the time they get around to investigating some suspicious activity ahead of an event like in ConAgra or Kraft, years may have passed, and trying to figure out who knew what when and who clicked the button where, it's really difficult. So that's why it still happens, and that's why I'm still able to, profit off of it and find it. They just busted up a huge insider trading ring that was being run overseas this past week or so, where they were using SQL injection attacks to take news reports from newswire agencies before they were released to the general public, and they were using it to trade the equity options market. Now, I would imagine that these guys who made about $150 million in 2 years doing this type of hacking and insider trading, I would imagine that a lot of what we saw in those other deals was driven by the order flow that they were producing as well. So it still happens, right? It happens pretty often. So let's say that I can identify a suspicious trade. How do I then determine whether or not it's an actionable idea for me to put some risk capital into? And this is where we come up with our trading plan for unusual options activity, and we call it the Oak Ribbit trading plan. So look at the order here that hit the tape 2 weeks ago on Wednesday, 2 weeks ago on Wednesday. So this is a relatively more recent alert. 3,000 of the EPD AUG25 puts were bought for 40 cents mid-afternoon, labeled as an opening position when the market was 30 at 40. And they obviously bought every single one that was on that offer because it was only 400 opening position. So I need to determine whether or not this is a trade that actually interests me, or if this is something that might be a hedge or a closing order. So one thing that I have to determine on the onset of every single alert that I see is whether or not it was an opening position. Now, sometimes it's pretty easy, and it'll be labeled opening. Brokers are supposed to label this stuff opening if it is, but they don't always do it. They don't always do it, okay? So let's assume that this wasn't labeled opening. If they bought 3,000 of these AUG25 puts, all I need to do is look at the open interest here, and if the open interest is less than the volume, I know it's an opening position. Think about that logically, guys. If I'm buying 3,000 contracts and open interest is 384, well, it can't be a closing position because there isn't 3,000 contracts there for me to close. Okay, so if volume is greater than open interest, I automatically know that it is an opening position. I only want to trade opening positions, and I really would like to see the volume as a huge, huge ratio over open interest. Because what does that mean? It means it's a more significant order. It's more significant to see 5,000 contracts being bought against 0 open interest than it is to see 15,000 contracts being bought against 10,000 in open interest. Both are clearly opening, but one is more significant. So after I determine that it's opening, and if it's not opening, I can't say in 100% certainty that it's opening, I won't even look at this next step. But then I need to determine if this is a speculative bet or a hedge. Okay, so I look at the chart to do this. Remember, there's 2 main participants in the equity options market, hedgers and speculators. So if I want to trade with institutional money, what do you guys think I care the most about? Speculative order flow or order flow that is being driven by hedgers? What's the most relevant to me? And someone just shot out an answer. I'm curious to see what you guys think. What do you guys think? Right, the speculative order flow, and everyone that answered that right away got it correct. The speculative order flow is the order flow I care about. I don't care about hedging order flow because a hedger is putting on a position hoping that it goes to 0. If it goes to 0, then they did good in their overall book, right? So I need to determine whether or not it's a speculative bet or a hedge. And I do this by looking at the chart. I want to determine what the most prevailing underlying trend is in a name, because institutions trade with the trend. So what do we see on the chart on the day these EPD puts were bought? Well, the stock was making a new 52-week low. It was trading well below the cloud, and we were below both of our major moving averages. The shaded area here is the cloud, and this is the Ichimoku cloud, and I can't talk too much about this because I could talk 3 hours explaining all of the finer points of this, but take this one thing away from this if you take anything at all. Anything below the cloud, the shaded area, is in bearish territory. Anything above it is in bullish territory. So I can see a very clearly defined bearish trend here. The cloud is sloping lower. I know that this is most likely speculative order flow. So then I need to determine what my risk, reward, and break even are and see if that lines up with my general trading strategy. I never want to risk more than 5% of my total book in one position, and I know that because these are only 40 cents, I can piece into a position or put on a position with many contracts without risking more than 5% of my book. This is really more important for smaller accounts because I want to trade everything with 4 lots at least because I always have 4 profit targets. So if I see an option trading for $2 and I have a account with only 10 grand in it, can I take that trade? No, because I can't piece out of it like I would want to. I'd be risking more than 5% of my book. In terms of stops, as an expert, I don't use a stop because I like to recognize opportunities to add to a position and to trade in and out and around my equity options position, maybe using the underlying stock as well. As a beginner, I can't risk that much. If I was a beginner trader, I'm not quite used to identifying these yet, I can't risk too much, a 20 or 50% stop. What is book? What is a book? My entire portfolio, everything that I have. My stock positions, my options positions, my cash, everything I've got. So, time and target. This is really important, and this is where most traders that are learning this trading plan go awry. And it all has to do with trading the same expiration and same strike as the institutional trader. If I truly believe that his order flow is significant and that the information behind it is more valuable than what I have access to, I can't tweak their order flow just to make it a little bit cheaper for me. So I can't trade a closer expiration or a further out of the money strike price just to save a couple of bucks, because I cannot tell you how terrible of a feeling it is to change that trade and then have a deal like Kraft come through and have yourself miss out on it because you didn't take the exact same order that the institutional trader did. If they have insider information, why wouldn't I want to do exactly what they were doing? Because they know what's going to happen, right? So watch how this EPD order worked after the stock after it hit the tape. They bought these sometime midday, and the stock continued to sell off throughout the day, making new lows. And this is what set up as a little bit quicker of a day trade setup. And we looked at a couple of examples that set up more so as day trades, some more so as swing trades. But this position went from 40 cents to 70 cents that day, all right? So as a day trader, I would absolutely love profits like that. And I didn't just pick a random stock to get short on a day when I saw these names selling off. I was driven into this by institutional order flow. This is where they were putting their money that day. Right? A 20 lot of these puts would have made $600 on $800 in risk if I was willing to let the whole thing go to zero. If I was using stops, I would have made $600 on even less in risk. And I can't ever get returns like that day trading stock. And in my opinion, I can't ever be guided to the higher probability setups like this in the stock market. The unusual options activity is what guides me to this type of trading setup. So I think I've got about 10 minutes or so left here. So I want to go and take as many questions as I can from you guys, but first I want to tell you guys a little bit about what our customers have to say about trading UOA with us. Charlie said, I want to take this opportunity to thank you for sharing your trading experience. I made $27,000 on Kraft this morning thanks to the unusual options activity trading plan that you taught me. Wayne says, I don't want to miss a single class, as all classes are 100% the best educational experience out there. Thank you. And Matt said, trading with KOTM has been very, very good to me, and he made over $1 million in our trading room last year trading unusual options activity using our unusual options activity trading plan. Okay, so I want to make an offer to you guys right now here. The unusual options activity trading plan workshop, we're going to be offering that on demand today. We're only offering 25 spots. Regularly we sell this for $497, so if you go to our website right now and try to buy this, it'll be $497. But we're going to talk about how to determine why call buying and put buying is not always as it seems, and how to figure out whether or not an order is a speculative bet or a hedge, what to look for to differentiate between speculative options orders and those placed against a stock position, how to determine opening and closing positions, and an in-depth, detailed breakdown of the Oak Ribbit trading plan to determine exactly what it is I want to risk, if anything, in an unusual options activity order that comes across the tape, and how to read volume versus open interest and why average stock volume is important. If you're a stock trader that day trades or swing trades stock, you can still use this unusual options activity info to your advantage, and we talk about that in this workshop as well, and it's only $97, which is an 80% discount from our regular price. So I'm going to go ahead and put the link in here for you guys to check this out. There's a lot of different places to get the unusual options activity order flow info from. Trade Alert is one place. Options Flux has a scanner. We also offer a scanner called Option Hacker. But most retail trading platforms, at least TradeStation and thinkorswim, have an unusual options activity scanner. And in thinkorswim, I'll show it to you guys right now, and we talk about how to use it in the workshop. It's called Option Hacker as well. And what it uses is something that they call the Sizzle Index. So the Sizzle Index shows me what stocks have unusual options activity relative to their average 5-day options volume. Okay, so if I use the Sizzle Index, and I'm sorry, I have a lot going on here on my workstation right now, so it's taking a second to scan. But this is the scan that would give me the unusual options activity for the day in thinkorswim. And then in the workshop, we talk about how to go into the time and sales window and break it down to something that's a little bit more granular. But what's great about the thinkorswim one is that I can intersect my scans with anything. So if I want to see where they're putting the biggest options bets to the bull side in oil stocks that have weekly options that trade in penny increments, that trade over $20 with a market cap of more than $1 billion, I mean, I can get as specific as I want, right? And that's what's really great about the Thinkorswim scanner. And TradeStation has something that lets you do this, and unfortunately I don't know too much else about it. I've just been told that it has a very similar tool. I've always traded with Ameritrade and Thinkorswim, so I don't have a whole lot of familiarity with their platform. But does anyone have any questions, any other questions, guys? I'm going to put the link in here again, optionsonthefloor.com/write. And as soon as you make your purchase, you get a link sent to you with this workshop contained in it, so you can start watching it right away. It's almost 3 hours long, so there's a lot of content to go through there. And as always, if you do not think that you got $97 worth of value out of this workshop, we don't want your $97. So just let us know. We'll give you your money back. We have a satisfaction guarantee with this. First of all, I'd be really surprised if you thought that there wasn't $97 worth of value or knowledge in this workshop, and I really don't think that you would. This is one of our most popular workshops we have ever done, and we sold I think about 3,000 of these over the past 2 years, and I can count on one hand the number of refunds that we've given. We do not provide any alerts with this. This is a workshop on how you can use the trading plan to your own benefit. I'm going to put the link in here again for you guys. So does anyone have any other questions here? Any other questions? I think I got about 5 minutes left here. So I wanted to take some time here at the end to answer questions. What did I say about volume versus open interest? So volume and open interest is how I determine whether or not a trade is an opening position, and I only want to trade with opening positions, and that's pretty logical, right? If I see an order hitting the tape, it doesn't necessarily mean that it's a trader getting into a position. If a trader buys equity options, they could be buying back options they were short. So I need to determine if the trade is opening or closing. I don't want to get in when they get out. I want to get in when they get in. Make sense, James? It's a great name there, James. Sure thing, Joe. So any other questions, guys? Any other questions? Like I said, we go over all of these topics in the workshop. It's about 3 hours long. I want to say probably about like 2 hours and 50 minutes or something. It's like almost every bit of 3 hours long, so there's a ton of content. And you get to go through it at your own pace, too. It's an on-demand workshop. You get access to the recording forever. So if you make your purchase, it's not like you have to sit and watch the whole thing through right away all at once. You have access to it forever. You'll never lose access to it. So you can always go back to it, reference it, brush up on your unusual option activity knowledge anytime you want. So any other questions, guys? Any other questions? I'll tell you one thing. I was looking at the XHB today. They bought a bunch of calls in that ETF not that long ago, and I bought some with them for 76 cents probably about 3 weeks ago, and I sold the last piece today for $2. Great, great trade. No, I want volume to be higher than open interest. Yes, so it's the $97 is a one-time fee. Yes, it's not a subscription. It is not a subscription. One-time fee, $97, and you get access to this thing forever. No, so I want volume to be greater than open interest. Right, so yeah, it works for pretty much anything. I can look for unusual volume in a lot. Typically speaking, we tend to focus on individual equities. Think about this. A big piece of the upside that you have when you're looking at unusual options activity is that sometimes those orders are driven by insider information. So is it easier for someone to have insider information on, company XYZ in the semiconductor space, or is it easier for them to have insider information on the entire semiconductor space as a whole? It's easier for them to have insider information on the individual stock, right? And this is why this also doesn't really work that well for, commodities or things like that. It's not like someone has insider info that Nat Gas is going to do a hostile takeover bid for crude oil, or that, wheat and soybeans are going to merge. It doesn't work that way. So a big piece of that upside gets taken away when we start to look outside of individual equities. But there are so many stocks with options that, you never will see a day that has zero opportunity. Do you prefer in the money or out of the money options? I prefer whichever options institutional paper is buying. So if institutional money is putting huge speculative bets on at the money options, then I want to trade those. If they're putting big too, right? I'm letting institutional order flow drive my signals and entries, right? Because they are the ones that have all of the information. So any other questions, guys? Any other questions? I think I only have about a minute and a half or so left here. I'm going to put the link in here again for you guys. Any other questions? Yes, we do offer an alert service. I think if you purchase this workshop, you might be given a chance to purchase a trial to that at a discount. I don't know for sure though. Yeah, so we go over how to use the scans in Thinkorswim. So we kind of go over like a general way of doing it because you can get really specific with Thinkorswim. So I show you guys how to, add filters and look at different things in Option Hacker to, hone in on the order flow that matters most to you. Because what matters to me might not matter as much to you, right? You might be someone who looks to swing trade more than day trade, or looks to day trade more than swing trade, so that will change your criteria. We talk about how to look at that, though, in the scanner. So any other questions, guys? Any other questions? Yes, this is not live. As soon as you make your purchase, you get a recording sent to you. You have access to the recording for life. It's about 3 hours long. You can watch it as many times as you want. You get it forever. No, we do not talk about TradeStation. No. We do not talk about TradeStation. So any other questions, guys? Any other questions? If not, I think I am pretty much out of time here. I'm going to go ahead and put the link in here for you guys one more time. And I'll also, in case you guys have any questions that come to you later or after you've had some time to think about this, if you want to shoot me an email, my email is james@alphashark.com. And I'd be more than happy to answer whatever questions I can. Alrighty, guys. So I think that runs through my time here.